Hello and welcome back to Simple Money Podcast, Canada's own personal finance podcast, presented in short and informative episodes. I'm your host, Matthew Sewick, also known as the Friendly Financial Coach. Today, we continue our investing series by looking at two very popular types of investments, mutual funds and exchange-traded funds, also known as ETFs. These are both very accessible types of investments that offer unique benefits to investors. Understanding how they work and when to use them can help you achieve your financial goals. Used properly, they can form the foundation of a very successful investment portfolio. However, care also needs to be made to minimize account fees. So to begin, both are considered to be pooled investments. The idea behind this is that your invested funds are grouped together with other investors to buy very large investment portfolios. The assets that are in this portfolio depend on the investment objectives, goals, strategies, and more. Some common examples include stocks, bonds, property, and others. So for example, if you have a Toronto Stock Exchange index fund, the holdings would be stocks found on the TSX in the same proportions. This way, the fund would mimic the TSX index. When you buy into a pooled investment, you buy units or shares and participate in the income distributions of capital gains, dividends, and income. However, you also share the losses and expenses incurred. One of the big benefits for both of these investments are that you have low cost diversification. This means that for a small contribution, you are able to have many investment holdings. Furthermore, diversified holdings reduce overall investment risk. Both investment types are also very subject to volatility, and there is the possibility that you can lose a portion of your funds or even all of it. This is why ETFs and mutual funds are not recommended for shorter term financial goals. It's also strongly recommended to not use these investments for emergency funds. This is because one of the big purposes for an emergency fund is protection from job loss. If there's an economic downturn, then you have a higher probability of being unemployed, and at the same time, it's very likely that your investments will drop in value. And this will be right when you need those funds. Both mutual funds and ETFs can be held in registered accounts like RSPs, tax-free savings accounts, and RESPs. Using these accounts can help eliminate or defer taxation. So focusing on mutual funds, these are pooled type of investments that really grew in popularity from the 1980s onward. These are also the main investment products that banks will probably try to issue you. Mutual funds are professionally managed and each has a specific investment objective, such as growth, income, following a specific country, and more. All details about a mutual fund must legally be listed in the issuer's prospectus. This includes objectives, risks, and other important details. A mutual fund dealer is also required to make sure that the funds that they recommend to you are adequate and suitable. One of the things that mutual funds are known for are their fees. There are many types of fees that a mutual fund can charge, but the biggest are called management expense ratios, also known as MERs, and load fees. MERs are a percentage that's charged annually on your total holdings. Most mutual funds have MERs that range from about 1% to 3.5%. You'll find that MERs will be higher when there's more management involved. A recent product that's often being pushed by banks because of its high MER are something called managed portfolio funds. These are essentially mutual funds of mutual funds. If you have a managed portfolio fund, it would be a good idea to check up on its fees and possibly look around for lower fee options. Load fees are another fee that mutual fund companies can charge. These fees can either be directly charged when you buy the fund or when you sell it. Fees can be very expensive, so it's always good practice to verify the fee before you begin investing. The big benefits of mutual funds is that they are low cost diversification, professionally managed, offer a large amount of options, and are fairly easy to sell. The disadvantages are high fees, the inherent risk involved, that they are often not suitable for short-term goals, and that they can lead to complicated income tax situations. Exchange-traded funds, also known as ETFs, are very similar to mutual funds, except for some very key differences. Due to their ability to have low fees and proper diversification, they are my investments of choice and what I typically recommend when I'm constructing an investment portfolio. Like mutual funds, they are pooled investments that can have a wide variety of purposes and objectives. However, ETFs are more passive in nature than mutual funds because they are meant to copy some kind of investment index, such as the Toronto Stock Exchange. ETFs are also traded over the stock exchange and have a price that fluctuates throughout the day. In comparison, mutual funds are only valued at the end of a period, usually the end of a trading day. One of the biggest reasons why ETFs have been exploding in popularity recently is that their fees are usually significantly less than mutual funds. Many ETFs have MERs that are around 0.1% or so. This is in comparison to mutual funds who have MERs ranging from 1% to over 3%. However, those that invest in ETFs need to be careful about commission fees that will be charged for every purchase and sale. To buy ETFs, you'll normally have to have a self-directed trading account, a robo-advisor, or a financial advisor. It's also important to find out if any of these account management techniques have additional fees attached to them. Taxation on ETFs is usually considered to be clearer than mutual funds as well. Typically, it's known whether you'll receive income, dividends, or capital gains. Another thing to consider too is that if you manage your own ETF portfolio, then you will need to pay commissions when you rebalance it. A good way to get into ETFs is to take advantage of a promotion that many robo-advisors offer, or to start doing your own self-directed account. And in next week's episode, we'll actually be exploring how to make your own investment portfolio. Thanks again for listening to Simple Money. Hope that you enjoyed the episode. If you have any questions or if you have any future episode recommendations, you can send me an email at info@ffcoach.ca, or you can find me on Twitter at F_F coach. Take care and see you next week.